Okay, we'll give everybody about another minute or two, and then we'll get started.
Okay, can you hear me now?
Yeah, you're good, Eric.
Yeah, I forgot I had to turn these on. I don't use them that often.
Is this thing on?
Yeah, is this thing on? Cool.
Eric, I lost my Wednesday fade today.
Yeah,
I got up.
yeah. I did two and ended up breaking even, but I did a 3 o'clock, which lost, and then I did a 3:45 or so, and it faded enough to where it offset. But the 3 o'clock one was really in the money, and the other one was just out. So I kind of broke even towards the end, but yeah, the morning was good.
Well, I mean, the puts paid for the calls, but my calls, I think I got a $4.60 credit, like 7 points in the money. So,
Wow.
so yeah, I lost, but I lost $30 each or something, 30 or 40, I don't even know.
Yeah, yeah. It's just like walk away.
Yeah.
see what
Yeah,
happens.
you know what I was more upset about is the assignment fee at Tastyworks.
It cost you $10.
Yeah,
It's $5, isn't it?
$5 a leg. So
$5 a leg. Yeah.
Yeah.
Oh.
Yep.
But if you have 10 spreads, it's still only
Yeah.
$5 a leg. So it's
So I tried to get
Could be.
out for $5. I couldn't get out for $5. And then I'm like, well,
Yeah.
let me try to get out for 505. I couldn't even get out for 505.
that's funny.
I mean, at this point, I'm like, let me see if I can save $3, like three, like actual
Right.
dollars.
We're up to 55 people, so that's
Wow.
great.
Nice.
Wow.
I see Margarita. Hi, Margarita. How's it going?
This is great. So I'm going, okay, I'm going to go ahead and, well, first of all, just welcome. I should probably put my video.
There you are. Yeah.
Yeah, sorry. Just want to welcome everybody to our Central Florida Options group meeting, and thank you, Lee, for volunteering to present, and Eric for bringing your group along. And so we have a great crowd. I think they're still coming in, so we're up to like almost 60, which is great. So today Lee's going to be going over the Strangle, which is a great trade, and he's done a lot. Used that a lot, and for really good results. So anyway, so I'm going to go ahead and start the recording, and then I'm going to turn it over to you to be the host, and I'll keep an eye on the chat box. So again, just welcome everybody.
Recording in progress.
And let me switch it over to you. Okay.
I was going
It's
to
all
say
yours, Lee.
I never did a Strangle before, and that I read about them, but you ruined my joke. I'm trying to share my screen. Give me just one moment here. I know there's a button for this. Let me share. Okay, can everybody see my screen?
Yes.
Fantastic. Okay, so today I'm going to do a presentation on how to trade strangles. It's actually a lot more than that. Let's dig into it here. So here's a disclaimer. It says that I don't know what I'm talking about, so don't do any of this. Not exactly true. But yeah, this isn't really advice. It's just my experience and what I've learned from doing it myself. Okay, so the outline for today, we're going to spend some time talking about the Greeks. To me, the Greeks are fundamental. It's the foundation. You can do certain types of trades without worrying about the Greeks, but I think strangles are so closely intertwined with a fundamental understanding of the Greeks that we have to spend a few minutes talking about it. We're going to look at the different plays. We'll spend a few minutes doing that, and then we're going to look at some live examples. So we're going to go into Tastyworks as my platform and see some trades that we could do, or some trades that I've already done, or a little bit of each. Okay, so first of all, let's talk about the Greeks. To me, strangles particularly are all about theta. So what we're doing is we're doing a short strangle. We're selling a call, naked call, we're selling a naked put, and we're collecting premium at the time of the sale. And the idea is that between the time that we sell those options and expiration, every single day they become worth a little bit less every single day. And the amount that it decays on a daily basis is called theta, and sometimes we like to refer to that as theta decay. And what we're showing here is that the extrinsic value of an option over time towards expiration eventually reaches zero. The value, the premium of an option might not be zero at expiration, but the extrinsic value is always zero at expiration. So it's really important that you understand that these decay over time. Most of you know that, but I think one thing that's important to realize is that when you're short an option, if you've sold an option, if you wrote a call or if you wrote a put, then most times you're collecting theta. And if you bought an option, then you're paying theta. So the advantage goes to the seller, particularly if you're out of the money. Okay, so the next one is Vega. Vega is the change in value with implied volatility. So when let's talk about what implied volatility is real quick. Implied volatility is the community's estimate of what they think the volatility of the underlying is going to be. See, we have a thing that's actual volatility. We call it vol or volatility, but IV is a prediction of what the volatility will be going forward. And then after the fact, we can come back and we can compare IV or implied volatility to future actual realized volatility. And what you'll find is that most of the time, the actual volatility was lower than the implied volatility. So let's take a look at what that means. One second here. So you can use IV or implied volatility to make a prediction about the range that the underlying will trade within, and that's based on something like the Black-Scholes pricing model. There's actually several models, but they're all kind of derivative works of the Black-Scholes. And what we can say is that there's a 1 sigma or a 1 standard deviation to the downside and to the upside. You see, we don't know which direction a stock is going to move, but we know the range that the community expects it to move within. So what do we see here? 68.2% of the time it's going to move within 1 standard deviation, and we sometimes refer to that as 1 expected move. If you see here, this 2 sigma is pretty safe. Only 4% of the time, or only 2% of the time, it'll be above 2 sigma, and only the other 2% of the time it'll be below 2 sigma. So when you look at this probability distribution curve, it tells you where the market sees the underlying going in a certain period of time, a certain time frame. Now, the thing that you have to realize about the market is it's a self-fulfilling prophecy. So if the community sees the stock trading within this range, that's where they're valuing the stock, and that's usually where it's going to trade. So this fact that it's a self-fulfilling prophecy and the fact that the IV is a measure of what the community thinks, it all works together so that this is surprisingly accurate. Okay, so it's expected to stay within some range. Plus or minus 1 sigma is generally considered the expected move. Okay, so let's take a look at an example. This is...
Hey, Lee?
Yep.
Could you I think there's some people waiting to get in.
Oh.
You just have, since you're the host, you have to.
Yep, give me just one moment to press
Sorry
a button.
to interrupt.
Here. We got Bud, JB, John, Joseph, Ken.
I think there's a button you can hit, admit all.
Is there an admit all? I
Yeah.
don't see it.
You're a fast clicker anyway.
Admit all. There it is. Sorry about that. Okay. Admit all. Okay, good. Okay, so I'm going to continue. Okay, good. So here's a chart of RUT. This is, what's RUT? Brian, remind me what that is.
It's the Russell index,
The Russell
cash index.
Is it the Russell 2000?
Yeah, Russell 2000 cash index.
Okay, so if you take a look at this chart, you can see this is over some period of time, several months. You can see how it's been kind of going sideways for a little while. Somebody out there tell me on October 1st, which at the time I had printed this chart, it was 41 DTE. What do you think the highest price this Russell 2000 is going to be? Do you think it's going to reach 5,000? You think, Brian, what do you think the highest it could possibly be is?
Oh, probably 2,500, 3,000.
Right. It probably won't. I mean, 3,000 is pretty darn high. 2,500 is kind of the top limit, maybe.
Yeah.
It's not going to 5,000. You know it's
No.
not. I know it's not. The whole community knows that it's not. And on the low side, what do you suppose it would go to on the low side?
Maybe 2,000.
2,000? Okay, so as a community, we can look at this chart and we can say, well, it's kind of range bound. It might go up, it might go down, but if it goes up, it's not going much above 2,500. And if it goes down, it's not going much below 2,000. And it's certainly not going to do it between now and October 1st. And if it does, it would be a pretty extraordinary day. It would be a more than a 2 standard deviation move. So what we did was we took a look at what that standard deviation looks like, and this is the cone that's drawn from the expected move. And what you can see is that based on the numbers that I'm getting from Tastyworks, they're telling me that the expected move by October 1st is between 2,000 and just over 2,300. So they're not making a prediction of whether the Russell is going to go up or down. They're just making a prediction of the range that it's going to trade within. And of course, this is revised all the time, every minute, every day. So it's even revised after the markets are closed based on events that are happening during the weekend and so forth, and things that are happening in the futures market. So when we look at this prediction, we can actually look at it as a probability distribution curve, and I'm showing it here with this bar, where green means that it's most likely to be within this range, and yellow indicates that it's very unlikely to be within that range. So you can see that predominantly it wants to come in right at the same price that it is, and it might go up or down, but it won't go up or down too much. Everybody understand what this probability distribution and distribution curve means? Do we have any questions so far on this?
Oh, we're good so far.
Okay, let me hit the...
Oh, here's one. It says, is there a time date scale for the bottom of that?
Is there a time date scale? Yeah, I accidentally cropped it off. Let's see. This is 2 years shown on the daily. So let me just pop open that just really quick. On the far left is June 2020, and on the far right is yesterday. Okay, so it's about, let's call it a year. Okay, so let's move on here. So the question of the size of this cone, right? What dictates how wide this cone is? What is the expected move, and what dictates that expected move? Well, what does that is implied volatility. The amount that the community thinks it's going to move. So if there's high implied volatility, what we end up with is a nice big wide probability distribution curve. And if it's low implied volatility, you can see here on the left that high IV is in red and low IV is in blue. If you have low IV, what you have is a very narrow probability distribution curve. So, and you can also see this chart is actually a chart of premiums for a trade that I was doing. What you can see is that when IV is high, the premiums go, it gets nice and wide and it gets higher premium. You can see in this case it was somewhere around a $55 premium. But when IV is low, not only is it more narrow, it has a tighter probability distribution, but you collect a lower premium, just over 40 in this example. So probability distribution and implied volatility are tied together, very, very tightly coupled. And what we can see is that we talked about theta, how it decays over time, and we talked about implied volatility, but this curve can show you, the surface, should I say, shows you what implied volatility looks like relative to theta. What you can see as we get closer and closer to expiration, the probability distribution curve gets more and more narrow, and the slope of this line changes, and what that actually manifests as is gamma risk. So when we're talking about getting out of a trade or managing a trade at 21 days or managing a trade early, what we're trying to do is we're trying to stay on this nice, smooth probability distribution curve that's almost a straight line and stay away from these wild swings that can happen with the stock price. So that's what IV and theta look like in 3D. Okay, so the next things that we care about are delta and gamma, and we know that delta is the change in the value of the option with respect to the change in the underlying, and gamma is the first derivative of that, which is just the change in delta with respect to change in the underlying. So what's that? That's a d delta dt. Okay, so let's look at that on a graph. With this particular example, we're looking at a $100 call with 20 days till expiration, and what we can see with delta is that if the stock price is $100, the 60 strike has a very low delta, with almost zero, because it has a very low probability of expiring in the money. And over here, this 140 strike price has almost a 1 delta, and that's because it has almost 100% likelihood of expiring in the money. And over here at 100, it's basically a 50 delta. It could go either way. It could go up or it could go down. Now, what's interesting is that's supposed to say gamma. Right here is where you have your gamma risk. If the stock moves a little bit to the left or a little bit to the right, you can see some extreme moves in the option premium price. But if you're out over here at the 120 strike and way over here on the left to the 80 strike, you have pretty shallow gamma moves. So something that's a lot more manageable. I hope everybody can see my cursor. Can you see my cursor?
Yeah, we can see it.
Okay, good. Okay, so let's move into what these plays look like. This is a short strangle. You can sell a strangle or you can buy a strangle. I never buy strangles. I sell strangles because I like to collect a credit at the time of the sale. I sell a put for a credit and I sell a call for a credit. And almost every time I do this, it's out of the money. So the current price would be just about halfway in between, because I like my strangles to be a neutral strategy. I like to make money whether the stock price goes up or whether it goes down. So when I first put it on, my strikes are off to both sides. My call is securely out of the money to the upside, and my put is far out of the money to the downside. And I expect it to stay within this range. And typically that would be a 1 standard deviation range that I put on. So let's look at a thing called a short straddle. It's just like a strangle, except you take those two strike prices and you move them together right towards the middle. So what will happen is you'll collect a higher premium at the time of the sale. When you sell to open, you collect more premium because the at the money call and the at the money put are more valuable than the out of the money strikes. You collect more premium, but what is it that they say? For every gimme, there's a gotcha. You collect more premium, but your probability of profit goes down a little bit, and it needs to stay in a much tighter range. Okay, so the next version of this is the short iron condor, right? So this is the strangle that we just looked at. We sell a put and we sell a call, but for an iron condor, we have 4 legs. So what we're going to do is we're going to buy a put and we're going to buy a call. And when we do that, what we're doing is we're making it so that we have a defined risk trade. You see, the iron condor, excuse me, the strangle as the price goes down, you can, if the stock price drops to zero, well, you're on the hook for every bit of that. And if the stock price doubles or triples or quadruples, you're on the hook for that as well. So we call that the tail risk. We don't expect it to move more than one standard deviation or more than two standard deviations, but it does. Sometimes it does. And when it does, you can really be on the hook. If you sold a naked call on AMC recently, maybe you sold a $20 call on AMC and the stock price went to 50. Now you may have collected a few bucks on premium, but you've lost a lot more than that because it moved against you. So what you can do is you can buy your own set of insurance on this, and you can buy a call option so that the most you can ever lose is the difference between the call that you sold and the call that you bought. And we call this the price spread of the vertical. This is actually a call vertical spread, and on the left side you have a put vertical spread, and those two things combined make up an iron condor. We call this a defined risk trade because we know how much we have at risk at any given time. Okay, and then we have another version of that called the short iron butterfly. Again, we just pulled them together and sold an at the money call and an at the money put for a credit. Okay, any questions on those so far?
So, couple questions. Rob said the only difference is the strike price, and Jason wanted to know about the buying power required to do a strangle versus iron condor.
Yep. We're gonna get into that a little bit. So the difference between the difference between a strangle and a straddle is the strike. A short strangle has the call and the put separated from one another, whereas a short straddle has them at the same point, typically more or less at the money. And as far as the buying requirements, the buying power requirements, that's going to be dependent on a lot of things. When you have a short iron condor, the buying power reduction is going to be the width of the spread minus the premium that you collected. So we'll get into this more in the examples, but in this example, say you collected $5 and you have a $10 wide spread. That means that the most you can lose is this $10 wide spread on 100 shares is $1,000, but you've collected $5 in premium, so that offsets your max loss, making it only $5. So $500 for the 100 shares. The amount of premium that you collect goes back to the implied volatility curve. If implied volatility is really high, that means that the option premiums will be very meaty and you can collect a higher premium. And if implied volatility is really low, then you have very small premiums. And we're going to look at a couple examples of those. Okay, so with a short strangle, you have this thing called POP, or probability of profit. You see the actual stock price can fall below your put or go above your call, and you can still be profitable in it as long as you haven't given back the premium that you've collected. And the probability of profit is something that I take a look at on every trade. I try to do strangles that are in the vicinity of 70%, 65, 70% probability of profit. So we'll look at some of those. So let's talk about the right way versus the wrong way. So there is no right way or wrong way. There's a lot of different variations, and they can all work. They all have their own pros and cons. So you have your high probability of profit strangles, and you have your low probability of profit strangles. Well, why would you do a low probability trade? Well, the answer is profit risk-reward ratios versus probability of profit are inversely proportional. So the higher your probability of profit, the lower the premium that you're going to collect on the trade. So if you want a nice safe trade that's way out of the money, you'll have a high probability of profit, but you're going to collect a low premium, and you might end up risking $9 to make $1. On the other hand, you could do a low probability of profit trade, Strangle. On that trade, you might only have a 50% probability of profit, but you might be risking one to make one. So they're both good as long as you understand the numbers that you're getting into there. I do a lot of lopsided strangles or biased strangles. I kind of belong to the school of stocks always go up. I know it's not exactly true, but a lot of days it feels like stocks only go up. So I tend to do my strangles with the put side a little closer to the money and my call side a little bit further out of the money. And there's nothing wrong with that. You can do your strangles perfectly delta neutral, or you could have a little bit of long or short delta to your strangle. And we'll look at some examples there, what that looks like. With iron condors, you can do them with tight spreads. You could do it with a dollar wide spread, for instance. It makes it almost a binary. Either you won or you lost. If it moves a dollar in your favor, you're a winner. If it moves a dollar against you, you're a loser and you lost everything. On the other hand, you could do it wide, or you could do it very wide. That spread could be $50 wide. Now the iron condor will start to behave a lot more like a strangle than a traditional tight iron condor. And we'll get into why you want to do that in just a minute. But I think it's important that you realize that there's a lot of different ways to do these trades. There's a lot of different variations, and you have to evaluate each trade independently, individually, and decide if it meets your particular criteria. They all have their own pros and cons. Okay, so let's look at some of the disadvantages of iron condors over strangles. Okay, so option sellers are advantaged over option buyers, right? When you're selling a put, you have an advantage over the people that are buying the put. And that's because, as I said earlier, IV is usually greater than actual future realized volatility, meaning that the premium is normally overpriced. So when you sell a put option, you're selling it for a little bit more than it's worth, because the way volatility plays out is generally less than the less volatility than was priced in for implied volatility. So as a seller, you have an advantage. So now if you think about that for a second, if you say, I'm going to sell a strangle, you've sold a call and you've sold a put, you're the advantaged seller for both of those. If you're also buying a put and buying a call, turning it into an iron condor, well, now you've got the bad side of those. Let's see. Can we tell whose microphone's on? Here we go. Okay, so by adding a long call or a long put to your strangle, you're actually taking a disadvantaged position. Now there might be reasons why you want to do that, but we're talking about the disadvantages of iron condors. Okay, so an iron condor is a strangle with a built-in hedge, but we know that hedges are expensive. You're buying insurance on your iron condor by taking a long position to go with your short strikes, and you have to pay the difference, and that hedge eats into your profitability. And because of that, you have a lower collected credit on an iron condor compared to a strangle, which equates to having a lower probability of profit, and that equates to having reduced theta. And because the hedge is built into the trade, it makes it a little bit less manageable. Okay, and the other risk is that you have a risk of 100% loss. With an iron condor, with a strangle, you're unlikely to lose 100% of your investment. But with an iron condor, if it moves 1.5 or 2 standard deviations, you could have a 100% loss. So if you have your entire account invested into iron condors, you might find yourself completely busted. But if you have your entire account invested into strangles, that's much less likely to occur. It could occur that you get a margin call and you have to sell some things and it hurts, but you're not gonna have 100% loss on any single trade, not normally. Okay, so let's see, when are iron condors better than Strangles. So we looked at when Strangles were better than Iron Condors and why, but Iron Condors can be better. And it might be that you want more leverage. Strangles kind of have a low return on capital or a low return on investment because Iron Condors have a more efficient use of capital. When you have a tight spread, you're actually buying more leverage, and that leverage allows you to increase your return on capital, increase your return on investment, your annualized return on investment. That comes at a cost of higher risk, but more leverage might be something that you want. And that might be particularly useful if you have a smaller account. If you're playing with only 10K or 15K or something under 25K, you might find that the leverage from an Iron Condor is a perfect match for you compared to the stability of a Strangle. And it allows you to invest in higher price underlyings. I went to do a Strangle today. I couldn't do it. I didn't have enough money in my account. If we're going to look at the example of IWM versus RUT. And what we're going to see is that RUT is trading for about 2,200 a share, or well, the index is 2,200 versus IWM, which is much lower. So in my account personally, I do IWM Strangles and I'll do RUT Iron Condors because that's all I can afford, or that's all I'm willing to allocate to that trade percentage-wise of my account. Okay, if you're investing in an IRA, you probably need to have a defined risk trade. Your IRA, your broker might not allow you to do naked calls and naked puts in your IRA, so that might be a reason. If you have a low number of occurrences, and it's complicated to why, but we'll come back to that. And if you're new and you're just learning, you can lose a fewer number of dollars with an Iron Condor because they're generally smaller trades than Strangles. So when we talk about more efficient use of capital, when we look at a Strangle, we might find that it has a $4,000 or $5,000 buying power reduction. But you look at the same Iron Condor and it only has a $500 buying power reduction. So because you have that more efficient use of capital and more leverage, you have a lower amount at risk on any single trade for a single lot, should I say. So if you're new and you're learning and you want to risk $200 or $500 on an individual trade, this is a nice way to learn the market, is using Iron Condors. And then when you get more experience, you might find that you've spent a lot of money buying long calls and long puts that you never really needed. Okay, so let's do some live examples. I'm going to go into my favorites. I'm going to sort by implied volatility rank, and we'll look at doing some trades. Okay, here goes. Give me just 1 second here. Here we go. Can you see this graph? This is live of the RUT.
Yeah, we can see it.
Okay, absolutely. So I like to do my Strangles at about 45 DTE. I like to copy the Tastyworks methodology. So maybe something like this 50-day expiration might be good. I don't like to do the AM, so I'm going to look at this 37-day expiration. So I'm going to open up the table over here, and you can see the current price is 2239, and you can see that's represented by this horizontal line across the middle. And up on the top right corner, I can see that the implied volatility is 25%, and that equates to an expected move of $112, right? So what that means is when you look at this graph, the current price right here is, we want to go $100 lower than that, or 112. So where am I? Somewhere, I don't, we'll do that, and we'll drop in another line over here. Somewhere like that. And there's our range of expected move. So going back to that, we we can see that they've marked off this area of the expected move with this red shaded, and they're calling this 1 standard deviation over here. So I'm going to click and collect $18.70 in premium to sell a 2065 put. I can see that the delta of this is a 17 and the open interest is 2. So I probably don't want to mess around with that because it's got an open interest of 2. I'm going to just go up 1. This has an open interest of 47. It's still a little bit light, but you can see here that the probability of this expiring out of the money is 82%. So it's telling me that my probability of profit on that naked put is 87% probability of profit. I'm going to go to the call side and I'm going to sell a call. Here we go. This is an 8 delta at 24.20. It's not meaty enough for me, so I'm going to go just a little bit higher up, maybe 2400. And I can see now that my probability of profit is 73%. I'm going to collect $24 per share, right? So that's $2,400. When I place this trade, I'm going to collect $2,400. But I have a buying power reduction of 28,707, right? So let's say this worked perfectly in my favor. I would collect $2,400 now. I would have a buying power reduction of, let's call it $29,000. What's that work out to be? 10% in 37 days. So as an annualized ROI, that's pretty good. What a lot of people will do is they'll take this off after a couple weeks, or they'll take it off if they hit a profit target of, let's say, 50%. And you can see here that this number P50 is telling me that I have an 89% chance of hitting my profit target of 50%. So if I were to do this transaction and then immediately put in a close order to take profit at 50% of max profit, I have an 89% chance of that happening. You can see here this number theta is really interesting. We talked about theta decay. I will be earning $92.66 per day as this thing decays with time. So I've sold these 2 positions short over 37 days, and I'm collecting basically $100 a day. And whoever bought these positions from me is paying me $100 a day for that right. Now let's take a look at what this looks like on the curve. Here's a curve view of it, and you can see that this is the log normal probability distribution curve at the 37 DTE. You can see the 1 standard deviation dotted line and the 2 standard deviation dotted line. And I might go back to the chart and say, I don't know, maybe I'm a little scared on the bottom side because it's really tested this 2120 a few times. So let me go out here and do that instead. And you know what? Maybe I think the market's going to crash, and maybe I'm not as afraid on the call side. Or maybe I'm very bullish, and if I'm bullish, maybe I'm going to sell an at the money put and leave room for it to go up. And if you see here, I'm collecting $60, collecting $60 a share. That's 60 times 100, and I'm putting $44,000 in reserve to do this. Now, a lot of people might be looking at this saying, hold on a second, I don't have $44,000 to put on the line for this trade, and if I did have $44,000, I wouldn't want to put it all into one trade. So that's when we go back and say, let's convert this over to an Iron Condor. So let's go $25 up from here, and let's buy a call, and let's go $25 down from here, and let's buy a put. And when we go back to the curve, did I screw that up?
The call side was wider, I think.
Yeah. Well, in this case, what we have is there. Is that right? There we go. Mm-hmm. There's math. So now all of a sudden my buying power effect is only $2,100. So this trade as a strangle took $44,000 to do, and now as an Iron Condor, it only takes $2,100 to do. So this becomes a trade that I now have enough capital to work with. But now instead of collecting $60 a share, I'm only collecting $4 a share. So, and you can see that my probability of profit has dropped to 69%, but my probability of 50% profit's gone up to 91%. My theta that was at $100 a day basically is now only $9 a day. So let's say I wanted to make the same amount of theta, I could pop up my quantity. Here we go. So now I'm going to do 11 shares, and you see to have the same theta, I'm risking half of the capital. Before it was 40 something thousand, and now it's only 23,000. So you can see how these two different trades, the Strangle versus the Straddle, have similar properties, but it allows you to tweak it in to suit your trading needs. So now Rut and Iwm, more or less the same. Let's take a look at this guy. Iwm, I have a position on Iwm already. You can see it's the same chart. I have a Strangle here. I placed it right there. That's where the stock was. This is my expiration. This is my short call, and here's my short put, and I would like it to stay within this cone. And you can see that after just a few days it reached this line, and I started to get a little bit nervous, and I said, well, we'll have to keep an eye on it. But it came right back up, and now it's right back in my trading range, and this is a very profitable trade. Let's go take a look at doing a new trade on that. Let me turn these guys off for a second here. We're going to go to the table, and we're going to look at 51 days. And at 51 days, the current price is 222. We're going to go up to the 16 delta. You can see right here, this is my delta column. This is a 16 delta put. You can see the expected move is 1351, which is this bar here. And I'm going to go 1 standard deviation on my call side. Look at that, it's only 46 cents. It's amazing. The put at 16 delta is $2.20, and the call, let's get the call up to 15 delta. Right here, you see the 15 delta call. We'll even go with a 17 delta call. It's only $1.20, and that's because when we look at the curve, it's skewed to the upside because the market is expecting this to go up. So a call isn't nearly as valuable as a put. Okay, so we're collecting in this case $316. You can see the number right here, and we have an undefined risk. You can see that if it drops down to zero, I've lost quite a bit of money, $15,000, and if it goes way up, I've lost a lot of money. But if it stays within the 1 or 2 standard deviations, I'm pretty safe. Even if I lose, I don't lose all that much. And how much do I collect when I do this? I'm collecting $316. My probability of profit is going to be 70%. My probability of 50% profit is 90%. That's amazing, right? I'm collecting $316, and I'm putting up $2,700 as collateral. So that turns out to be a greater than 10% return on capital in this 51-day period.
Hey, Lee.
Yep.
On the previous slide, when you had the Rut, the 2400, and it came up to 24 premium, would you mind just going back, because it confused a few people that the premium was 2400 and your short put was 2400. So just maybe you could just walk through that again.
Okay. I'm not sure I understand.
Maybe it was, well, on the Rut, I
Okay,
think you had
I'm back on the Rut now.
Okay, so on the, I guess it's the call side.
Okay.
You had a 2400, and then you set the other, it was just a Strangle, it wasn't the...
Okay, so we'll delete that leg and delete that leg.
And somehow it ended up being 2400 even for the total credit. And then and I think when you went on the table, it showed, if you switch to the table, it shows that we sold the 2400 call and the credit was 2400. Steve, does that make sense?
Okay, so the 2400 call pays $5.50 premium, and the 2060 put is paying $17.90 premium, and those combined equal $24 for a total credit of $2,400.
Perfect.
Okay. Now, and if we want to define our risk on that, let's go back to the table. We're at 2,400. Let's buy a call. This is a $5 spread. You see it's 2,400 and 2,405, a $5 spread. And we'll go to the put side, and we're going to buy a put with a $5 spread, 2060 and 2055. So going back to the curve view, what you can see is that we're collecting $1.05 in credit. Now, because the spread is $5 wide, we're at risk of losing $500 minus our credit, which brings us to a buying power reduction of $3 or $395. And on this, I would expect to earn $2 a day in Theta Decay. And my max profit is 105. And if I go to place this trade, it will tell me that my commissions are going to be $4. My estimated fees are going to be $1.24. Those are exchange fees and so forth. It tells me what my resultant buying power is going to be, and it's going to be reduced by this amount, $400.24, which is $395 plus fees. Okay, so we'll clear that order. Okay, so let's take a look at some of the ones that I actually have in place right now. Let's see. Here we go. Here's XLE. Let me go to my notes on XLE, if you don't mind. With XLE, I actually put the Strangle on way over here to the left, and I just keep on rolling it forward every 2 or 3 weeks. I just take it and I reposition it and just move it forward more and more and more. And every time I roll it forward, I collect a new premium. And you can see that currently it's a little bit outside of my cone, but I don't care. It's nowhere near my strikes, so I'm not worried about it. Let's see. Here's one that I just put on today. This is Snowflake Ink, ordinary shares. This is a Strangle that I just put on. The IV was pretty high. I put on let me check my notes here, a 335 call, which is a 17 delta, and I put on a 230 put, which is an 11 delta. And if we go look at this, let me put that trade back on here and just see what it says. You can see here that it says it has a 76% probability of profit. I can tell you that I collected $690 for this today. Right now it's worth $695, and you can see that the buying power effect is $9,000. So I'm looking at making about $700 on about $9,000 in investment over a 37-day period. And I need it to stay within that range. And I expect it to. The reason why premium was so high is because IV was elevated, and the reason IV was elevated is because there were earnings after market close today. And right now, it jumped up to this yellow line right here at 550. It jumped up to this yellow line, so I know that tomorrow it's going to be a lot closer to my call side than it is to my put side, but I'm still not worried about it. It's still going to expire within my expected move, and I'm still going to get to collect or keep the full amount that I collected, which was $690 minus fees. Okay.
Hey, Lee,
yep.
On that one too, after the earnings come out, the IV will also collapse, correct?
That's a great point. The IV rank at the time that I placed this trade was 25, and currently the IV rank is 21. So it's already dropped 4 IV rank points. But IV itself, the amount of implied volatility is gonna drop tomorrow pretty dramatically, and we call that IV crush because the premium that I sold had a certain amount of IV built into it, because we didn't know what was going to happen with earnings. Well, tomorrow, when the market opens back up, we know what happened. So there's no unknown surprise coming down the road. So that it was priced into the option premium, and now it's getting priced out. So the amount of IV crush is going to be my profit for tomorrow. Now it moved closer to one of my strikes, so the delta on my call was 11 and the delta on my put was 17. So the amount of profit that I made on my put is going to be less than the amount of loss that I had on my call. So I will have lost money directionally, but because there was an IV crush, Vega compensated for my delta. So when the market opens up tomorrow, this will have been a profitable trade. And I may keep it on and I might get rid of it. I don't know yet.
Hey, Lee,
Yep.
in terms of what is a good IV range to look for?
That's a good question. I was looking at some examples here. We like to talk about IVR or IV rank, and I went into some of my favorites here and I sorted by IV rank, and you can see this guy here, GE, has a terrible IV rank. What we can see is this graph on the bottom is the amount of implied volatility, and you can see that it's as low as it's ever been. And by looking at the chart of GE, you can see it's been range bound for months and months. So nobody's really expecting this to do anything crazy. Now, because of that, that's going to dramatically affect the option premiums. This is a $100 stock. We're going to go to the table. We'll look at the 51-day, and if you see, well, the expected move is $7 in 2 months on a $100 stock. I mean, it's just super low. And if we wanted to go out one standard deviation, we're only collecting $1.50, right? So I'm making $150, but you can see that the low volatility affects the amount of buying power as well. I only have to put up $1,000 in collateral to earn $1.50 in premium. So it's kind of interesting because when you find that the IV is lower and therefore you collect less premium, that reflects in the amount of capital that you have to put into reserve to go along with it. So what I start to look for is how much credit do I have compared to how much buying power effect do I have, and how much theta am I collecting per day compared to the amount of buying power that I have to put up to collect that theta per day. Now you would expect that GE would be the worst one because it has the lowest implied volatility on my entire watch list, but you can see that it's really not terrible. I'm making $150 in credit and risking a buying power reduction of $1,000. Now here's the catch. Buying power reduction is not the amount of risk that you have. I'm not risking $1,000. I'm risking 100 shares at $100. So I can lose quite a bit more than $1,000. Or the stock price could double. It could go up to $300 or $400 in this period of time, 51 days. Is that likely to happen? No, I don't think it's likely to happen. The market doesn't think that it's likely to happen based on this out of the money column and based on this delta column. And the risk management department at the at not Tastyworks, but the whatever, the people underwriting this, they don't think that it's a very high probability of risk. So yes, we could have a 10 standard deviation move, but the chances of that happening are very, very, very low. So what you care about is buying power effect versus theta versus actual risk versus the amount of capital collected, and it has to work out to be a pretty reasonable number. Let's look at square. Is that what it is? Square's 270. I'll go one standard deviation out. Here we go. We're collecting $530 on a $2,700 risk. That's not terrible. Let's take a look at the chart. Well, that's range bound. So maybe this $530 on $2,700 is a good investment. Maybe that's a good return on capital. Let's look at that as a Iron Condor. We'll go $10 wide on the Iron Condor here. This is a 10 delta put and a 16 delta call, both $10 wide. And when we look at that, what we can see is that we are going to collect a premium of $186, and we put at risk $814. So this is actually a much lower return on capital compared. Is that right? What do we have here? Let me just pop this open. Right, so that's a 22%. I stand corrected. Okay, so the Strangle is a 20% return on capital, but the Iron Condor was a 23% return on capital. If you see here that the Strangle has a probability of profit of 79%, but going back to the Iron Condor, our probability of profit drops down to 75%. So you can see that these are very similar trades. They have a lot of similar characteristics. One of them is a smaller scale than the other. But let's go back to this chart. Let's say you think it's at the top side of its trading range and that there's no way it's going to get above 300. I don't particularly like to trade like that, where I have to predict what the market's going to do because I'm wrong often. But let's say you've decided that there's no way it's going to get above 300. So now you might take this and move it down to the 23 delta put, excuse me, the 23 delta call, and you might move the downside put, and now you have it a little bit skewed, a little bit lopsided to the put side. So there's a lot of different ways you could do it. You could say that you want the call side to act more like a undefined risk play, and you want the put side to be as tight as possible, and you end up with different characteristics of it. One thing that I often like to do is I like to get two calls a little bit further out, and when you look at it, what you can see is that this delta is 11, but because I have two of them, it's a 22, versus my put, that's a 21, and you end up with something that's a little bit lopsided. It has a little bit of a different characteristic to it. Okay, so we could also do this. Let's change this.
Hey, Lee,
yep.
Could you just show everybody how you go out one standard deviation on Tastyworks?
Sure. So you have table view and you have curve view. Let me just clear this. So we're looking at. Let's go to something we haven't looked at yet. XLI. Here we go. XLI. I'm gonna be in this curve view window. I hit trade, I've hit curve, I hit analysis. I'm going to go over here and I'm going to say give me a strangle, short strangle, and here it is. Now looking at this, it automatically defaulted to this 16 DTE, so I'm going to bump out the expirations a little bit further. Now I'm at 51 days, and just looking at this chart, I can see this dotted line here that puts me at about 1 standard deviation, and this dotted line puts me at about 1 standard deviation. So that's one way that you can do it. Or you can go into the table view and you can see here what your expected move is for 52, You can see this dotted line, that's a standard deviation, and you can see this dotted line, that's a standard deviation. But this little brown line in the middle tells me what that expected move is. So I can put it right here, and that is just outside of one expected move. I've been loosely referring to one standard deviation as expected move, but they're slightly different. The standard deviation is usually just a little bit bigger than one expected move. I'm not 100% sure how they come up with these numbers. But what I'm looking at here is this is a 22 delta and this is a 17 delta. This has a probability of expiring out of the money of 75%, and this has a probability of expiring out of the money of 86%, which gives me a total probability of profit of 67%. So I can take these and I can move them around to change those statistics. 86% probability of out of the money, let's change it to 89% probability, or 92% probability, and now my probability of profit on the entire trade is 71%. And we'll go over on the put side, it's 75. Let's bring that up to 81, and all of a sudden I'm at 76% probability of profit. So all of these numbers in the table play together to give us a probability that we're happy with, and you can see those graphically on this chart. This is actually a parity chart, but they overlay it with some statistical log normal distribution curve information.
Hey Lee, one other thing, can you just show people the cone that you used on snow earlier?
The cone?
Or, you know, that basically the one standard deviation kind of expected move, I think you called it. You referred to it as a cone.
When I did it on the graph.
I think. Yeah.
Well, so that's a feature that's built into Interactive Brokers and some others, but that's not built into Tastyworks. I don't have a button where I can say, show me the cone of the expected move.
Gotcha.
Okay. So what I would have to do here is I would have to go to the table view, see that it's 452, and personally what I do is I just draw those two lines in. I just put them right there on my chart and manually draw them. I manually draw in my expiration date, and I manually draw in my one second here. I will manually draw in my cone. So some tools like Interactive Broker you just check a box and it will show you that information automatically, but on Tastyworks it just doesn't do that for you. So these are just chart drawings, nothing too special. But for me it's important because I can look at one of my positions. Let's go back to my positions. Disney, right? I can look at this Disney position and I can see exactly where I'm at with this. Just at a glance, I know if I'm in trouble or if I'm on track. This was another one that I did just before earnings. In this case, I didn't know that earnings were coming because I wasn't paying close enough attention. It spiked way up here after market, and then it came right back down, right into my cone. And I can see very visually, very graphically that I'm on track, that this is expiring, and I'm collecting theta every single day. So, okay, let's see. Here's a Boeing Strangle. You can see that it's kind of got outside of my cone a little bit, but it's fine. I'm going to roll as soon as this price action gets back inside of my cone, I'll be able to roll it forward for a nice credit, and I'll just bring it forward to the next expiration and recenter it and collect a nice credit, and just keep on doing that as long as Boeing has enough meat on the bone. As long as Boeing has enough implied volatility to make it worthwhile for me to stay in the strangle, I'll just keep on rolling it forward. PayPal kind of bit me. I did the strangle over here and I've rolled it, and I'm trying to wait for it to get back inside of my region, and I rolled it here. I rolled it forward in time. I actually rolled it forward in time and collected a credit to bring it to this date, and I'm kind of bullish on PayPal. I think that in a short period of time it's going to be back within my strikes, and I'll make a bunch of money on it. That's the plan.
So when you get one side challenged, can you just maybe touch on how you do defend that?
So there's a lot of different ways to manage the trade, and it depends on your outlook of where you think it's going to go. What I don't want to do is I don't want to get whipsawed, right? And what I mean by that is I don't want it to kick back on me. What somebody else might have done is they might have said, you know what, this has gone way down, and now I want to recenter it lower. But I know I don't know. You know what it's like. You think you know. I think I know that PayPal is going to come back, and PayPal is very bullish, and it's going to continue to be bullish, and that if I lowered my strikes, I'm going to regret it. So in this case, I didn't lower my strikes. In this case, I didn't do any management at all except for rolling it out into the future and patiently waiting for it to come back. Now, I do have, let's see, give me 1 second here. I do have about $2,700 of buying power reduction waiting for this to come back. And that's okay. I can keep that $2,700 invested in this indefinitely until it gets between my strikes. It might never get between my strikes. Implied volatility is mean reverting, but price is not mean reverting. There is no guarantee that it's ever going to see this strike price again, but I think it will. So my management for this was to extend it out in time. But with a
Hey Lee.
Yep.
Hey, this is Eric. When it went down like that, I would imagine that the call side is worth very little. So, is it worth taking profits there, or is there still enough, premium there for it to matter? Because in theory, if it did bounce back as you think it might, then you would in theory make more money on the bounce back.
Right. So when I rolled this forward, so when I originally sold it, I was about here. And when I rolled it forward here, this call was worth about 2 cents. So I sold the call that had a premium of, I bought to close my naked call that had a premium of 2 cents. Let me check my records here. I have no idea what I sold it for.
When you rolled it, it was worth nothing, basically.
Basically nothing.
Okay, so that's what I was thinking. So when you rolled it out, it would have, that's probably why you got a credit, right? Because in the future it does have something.
So now the premium on this call, it was pretty low even at this expiration date, but I originally sold it for, let's call it, I'm going to make up a number here. I really don't know the answer. $1. I know because it was a strangle. I only notated the total credit. I didn't notate the call credit by itself. So let's say I collected $1.50, and here it was worth 2 cents. And then I bought it back for 2 cents. I sold it for $1.50. I bought it back for 2 cents, and then I sold a new one further out. It's not worth $1.50 anymore because it's so far out of the money, but it was still worth 45 cents, 60 cents, something like that.
Right. Okay.
So now the put, because the put was in the money, maybe I originally sold it for $1.50, but now when I bought it back and rolled it, maybe I bought it back for $10 and sold a new one for $12.
Right.
So, yep.
Gotcha.
So what a lot of people will do when they manage, let's see if I can find one that went sour on me. No, I really what you can do is you can take one side. Bat and Tom likes to talk about rolling in the untested side. So what I might have done on PayPal is I might have closed out this one for 2 cents, and I might have sold a new one. I might have converted this into a straddle instead of a strangle, right? And by selling a 290 call, that would change the characteristics of this pretty dramatically, and we can look at what that looks like. I can take this one and buy it back and sell this, and now all of a sudden I'm profitable in the trade just like that. I take a trade that I was losing on, and by selling an at the money call, it's profitable. But the problem with this is that I'm expecting it to move outside of this more narrow window. Okay. Okay, what other questions do we have here?
I think that was it.
Okay. So one question I was thinking about is portfolio allocation, right? A lot of these are making 10% in 2 months or 7% in 2 months, that sort of returns. These actually make up the bulk of my portfolio because I consider them just kind of plain Jane vanilla trades. I don't feel like they have a lot of risk. I do a lot of XPX trades that that have a lot of volatility to them, but these strangles is where I apply my extra cash. Every once in a while, one of these puts will get tested and I end up converting it into a wheel, and then next thing you know, I'm selling covered calls on it. But once I'm out of the covered call, then it becomes a strangle again, and I just do the whole cycle all over again. So my variation of the wheel is it starts with a strangle and then becomes a covered call instead of starting with a cash secured put. So, okay. I see a bunch of messages in the chat box, but I haven't read any of them.
I've been answering them.
Great. Great. Okay. Well, that's about all I have. So.
Okay. So, Lee, if you can either make me the host or stop the recording.
Let me make you the host. Make host. There you go. You are the host.
Okay. So I'm going to go ahead and stop the recording.